Good evening, we are Group 9 and this is our Procter & Gamble case. So just as a brief overview, we'll be going over the case background, what type of derivatives were used, a more in-depth case analysis, as well as court rulings, recommendations for P&G on what to do about their leverage swap, and lessons learned.
Let me start with case overview and introduce P&G business first. P&G boasted a diverse product portfolio, including laundry detergents, diapers, and beauty items with a strong global footprint. The company frequently launched advanced product formulations. Furthermore, P&G iconic advertising, often featuring celebrity endorsements and emotional narratives, effectively built brand loyalty. The P&G had a complex derivative transaction, a leverage interest rate swap with bankers' trust in 1990s. This type of swap would be viewed as a general interest rate swap and options on U.S. Treasury bonds. P&G signed a leverage swap with bankers' trust, which opposite related to the interest rate changes. When interest rate increased, P&G would lose money. Thus, P&G filed a lawsuit against banker trust for banker trust fraud and misrepresentation. The principal participants include Treasury Department of P&G and Banker Trust. It also included Kevin Hassan, the managing director of Banker Trust. The type of derivative used that P&G signed with the Banker Trust is the leverage interest rate swap. For the first 6 months, the P&G was offered a fixed interest rate of 5.3%, while Bankers Trust was given a 30-day average commercial paper market floating interest rate minus 75 basis points. The rate for the remaining 4.5 years of the swap will be determined using a complex formula that added a spread, which is highly related to the interest rate. This type of swap was more risky. And the purpose of the derivative for P&G is it want to use the interest rate swap to pay for the floating rate, which may be lower than the fixed rate. And there are 3 reasons of the scandal. P&G was looking for ways to reduce its financing cost, and the swap provided by Bankers Trust can satisfy its requirement, reduce its financing cost, and hedge its financial risk. Another reason is the complexity of financial instruments. It has strong possibility that P&G didn't fully predict its risk. Also, due to the long-standing relationship between P&G and Banker Trust, P&G signed the contract out of trust in Banker Trust without fully understanding the terms of the swap, which created a significant risk for P&G. Next one, please.
Now, going into case analysis, we want to ask whether P&G Treasury was operating as a profit center or a cost center. And we believe it is a profit center. But they, as a consumer goods company, should not dabble in interest rate swaps for profit. We believe Treasury should serve with 2 goals. First is minimize cost of capital, and the second is to limit exposure to interest rate risk and exchange rate risk. And to improve, we believe Procter & Gamble should build a portfolio that covers exposure from both directions, and they should include an investment team in the Treasury with investing professionals, and then they should make strict regulations and guidelines. And for formula, the mismatch formula built by Bankers Trust, it is a more risky because the yield and the prices, it creates a bigger leverage, and they move in the opposite directions. For example, a small interest rate hike from the Fed can lead to a smaller increase of 5-year CMT yield, but create a bigger decline in 30-year Treasury bond. But on the other hand, a 5-year Treasuries and a 30-year Treasury, they are based on a more stable and consistent measure of the yield curve, because they have the same credit quality and their prices move in the same direction. The difference is only the maturities. And next slide, please. Here we do a break-even analysis. When the spread is 0 basis point, the break-even 5-year CMT yield would be 5.57%. And when the equivalent is $0, the break-even 5-year CMT yield will be 5.61%. And that's our case analysis.
P&G sued Bankers Trust for various charges, but most were dismissed. 2 rulings were established. First, the leveraged interest rate swap was not a security. Second, Bankers Trust had no fiduciary responsibility. The first was significant for P&G since it cleared a way for a lawsuit based on common law fraud, but the second was disappointing given their trust-based relationship. The 2 parties settled out of the court, with P&G paying only $35 million instead of $157 million, excusing 83% of the debt. Next slide, please.
So on the point of fiduciary responsibility, the judge made the decision that Bankers Trust did not owe any fiduciary duty to Procter & Gamble. And the reason for this was based on prevailing New York state law that when these two entered into a swap contract, it constituted a business relationship, not a fiduciary relationship. So based on prevailing law at that time, the judge did make the lawfully correct decision. That being said, some potential hedges or recommendations for Procter & Gamble would be to reduce the swap's risk on interest rates. And basically, because they took a leveraged long position by writing put contracts on these U.S. Treasuries, one of the ways they could kind of mitigate the risk would be to short the 5-year CMT and 30-year Treasuries in an equal manner or ratio to the synthetic 530 portfolio that was created through those written put options or viewed as written put options. And the cost or premium to buy this hedge would most likely exceed the 75 basis point premium paid by Bankers Trust just because of how leveraged and the amount of hedges or contracts that would actually need to be purchased. And as the interest rates increase, the cost of hedging would also increase. Because they're shorting these treasuries, as interest rates increase, these treasuries will decrease in price, which would increase the cost of their put options to purchase. Some other recommendations could potentially be a duration-based hedge, where they short treasury futures to offset kind of the spread's synthetic portfolio to 0. But the issue with this is that there's a risk of a non-parallel yield curve shift, and in this scenario, the hedge no longer is completely accurate. Another idea that they could have would be to take a leverage swap in the opposite direction. They could pay a high premium to somebody else to get a swap in the opposite direction. But the risk of this is that there'd probably be no counterparty because of how risky the swap they entered into in the first place already was. And by the time they realized, it was already too late. So the best recommendation for Procter & Gamble would have been for proactive risk management, so such a scenario wouldn't have happened. Because the price and the yield were mismatched in the formula rather than a price to price or yield to yield on the 5-year and 30-year treasuries, there was way too much leverage, and it was an instrument that they didn't understand to the core.
The first lesson from the case is the importance of thorough risk assessment. Companies must analyze worst-case scenarios and potential losses in complex financial transactions. This involves using advanced models like stress testing, value-add risk metrics, and multiple scenario analysis to evaluate risks and quantify potential losses. Second, establishing a clear mission for the Treasury Department is crucial. In P&G's case, the focus should be on minimizing capital costs and risk rather than speculative profit-seeking through interest rate swaps. Failing to define and adhere to clear treasury mission can lead to company failures. Third, when dealing with complex OTC derivatives, companies should update internal monitoring and external supervision. Internally, board members should be closely involved on strategic shifts, such as a shift from a cost-centric approach to a profit-centric one. Externally, unlike exchange-traded products, which mandate daily margin collateral posting market to market, OTC derivatives lack this built-in mechanism for reality check. P&G's preference of OTC trading over exchange-traded leads to risks on a misunderstanding of leverages. Thus, corporate users of tailor-made derivatives should establish in-house reporting systems mirroring exchange-traded product margins. This enhances transparency, enabling better risk assessment, particularly concerning factors like leverage. Thank you so much for listening.
That concludes our presentation, and we'd be happy to take any questions over email.